This one will put money in your pocket. Get your pen and pad handy, screenshots, whatever you need to do in order to remember this. Save this because I know it'll help you or someone that you know. So let's talk about a standard mileage versus actual expenses and getting the biggest tax deduction. This is one that I absolutely love for several reasons, and you just have to figure out which one works best for you. But the question that many people often ask is, should you use the standard mileage or actual expenses method? Well, if you drive for a company such as Uber, and the business use of your car is probably your largest business expense because you know they drive around a lot, and obviously that requires them to use their miles and or pay money. So taking this tax deduction is one of the best ways to reduce your taxable income and your tax burden. Now, this is not just for the person who drives for Uber. If you're self-employed, if you have a business that generates you income in the pursuit of a profit, then you using your vehicle for business positions you to get a ton of tax deductions. Uber is just a good, easy example because you know that it's definitely required to use your vehicle. That said, let's keep going. So this is doubly important because you have to pay two separate taxes on your ride sharing income, once for your income tax, once for your self-employment tax, the amount you contribute as a self-employed individual to Social Security and Medicare. Now, it's ways to save on the self-employment tax. Many people shy away from certain business entities and self-employment. They always talk about the self-employment tax. Well, there's ways around that, and I'm going to do a whole deep dive on the power of being self-employed and a sole proprietorship in another series. But nonetheless, let's keep going. So both taxes are based on your net profit of your business, which can be reduced by taking a deduction for the use of your car for your business. So if it's based on your net profits, then why not figure out a way to minimize your tax liability by reducing and using tax deduction? That's what this is all about. So the IRS offers two ways of calculating the cost of using your vehicle in your business. Number one, actual expense method, which is pretty much self-explanatory. I'll dive in a little deeper, but it's just the actual expenses, the amount of money you use to keep the car up and running so you can remain profitable. Or the standard mileage rate, which is my favorite for several reasons. And, I'll tell you why. So each method has its advantages and disadvantages, and they often produce different results. Actual expenses might produce a larger tax deduction one year, and the standard mileage rate might produce a larger deduction the next. But this is the question that you got to ask yourself, and this is important for your tax professional to understand. If you need access to some experts, you know what to do, link in description. But if you want to do it yourself, then I can show you how you can save some money as you file it yourself and put more money back into your pocket. That's also in the description as well. But the question that you got to know is, can you switch between standard mileage and actual expenses method? Well, if you want to use the standard mileage rate method in any tax year, you must do so in the first tax year you use your car for business. What does that mean? It's simply put, start off, and this is not financial advice, but it's better to start off using the standard mileage because it positions you to be able to switch if you start off with that method versus if you start off with the actual expenses. So that said, in later years, you can choose to switch back and forth between the methods from year to year. Each year, you'll want to calculate your expenses both ways, then choose the method that yields the larger deduction and greater tax benefits to you. So if you use the actual expense method in your first year, you are required to continue to use this method for that specific vehicle in future years. So it boxes you in. If you use the actual expense, but then you realize, damn, I've been using or driving more driving more miles. So it really would have benefited me more to use the mileage. Now you're not supposed to switch due to the fact that you used actual expense in the first year. So instead of being boxed in, it's just better to use the standard mileage rate. Now, I love that one so much because many people drive 10,000 plus miles on their vehicle. Well, depending on what year it is, that could be over $6,000 in tax deductions if the bulk of those miles driven were connected to your business. So you need to get strategic on how you can make the miles that you drive tax deductible. And I'll let you know what the rate is this year and the rate is for the previous year. So how are expenses categorized for rideshare businesses? And again, this is way bigger than just ride sharing. This is a person who's using their vehicle for a business. They're just using ride sharing as an easy example. So as a self-employed owner of a ride sharing business, you'll report your business income as well as your business expenses on the Schedule C. The chart below breaks down total rideshare business expenses into two main groups for 2024. So number one, common operating expenses, and then vehicle expenses. So you see that here's some vehicle expenses. You got gas, you got depreciation, fees, insurance, lease payment, registration, washes, tires, oil, repair. Or the standard method for the year tax year 2024 is 67 cents. Well, for the year tax year 2025, it's actually 70 cents. And I haven't seen it get that high. So what that means is for every mile you drive, you get a 70-cent tax deduction. 70 cents. For every 2 miles you drive, $1.40. So if you drive 10,000 miles that were, a part of your business, then that's $7,000 in the form of a tax deduction. That's pretty significant. Now, the question you must ask yourself is, will you spend $7,000 on gas, depreciation, fees, insurance, lease payment, repair, oil, tires, washes, registration? For some, yes. But for others, probably not. But still keep in mind, if you're just now using this vehicle for business, why it may make sense to actually use the standard mileage. So many of the items listed in the chart apply both to your business and your personal use. For example, you might use the same phone and wireless plan for both your business and your personal life. For tax purposes, you need to calculate the percentage of each expense that applies to your business and deduct only that portion from your business income. The IRS can disallow expenses that are not supported by receipts, mileage logs, and other documentation. So for this reason, many people use a bank account or credit card separate from their personal accounts for all their business transactions. That way they can refer to their monthly statements or online records to accurately track their business expenses. So how does the actual expenses method work? We'll break through this and then we'll, wrap it all up. But as the name suggests, the actual expenses method requires you to add up all the money actually spent in the operation of your vehicle. For example, if half the miles you drive are for business and half are for personal use, you will multiply the total vehicle expenses by 50% to arrive at a business portion of $9,500, which is total expenses, 50%, 0.50 represents 50%, which equals $4,750 in business expenses. So if you had a total $9,500, you multiply that times the 50%, and you got $4,750 in business expenses. Some of the costs you can include in your actual expenses are lease payments, auto insurance, gasoline, and it's emphasis on lease payment, not just the car note. It's different. Lease payments, allow you to get some tax deductions, but auto insurance, gasoline, maintenance, new tires, title licensing, vehicle depreciation. So screenshot this, just so you can have it for your records if you don't already know. Now, tax pro tip. Compute your mileage deduction using each method and then choose the method that yields the larger deduction. Just something to consider. So how does standard mileage rate work? Well, the standard mileage rate method is a much simpler way of calculating the deduction for the business use of your car. It does not require you to track individual purchases and save receipts. Instead, you simply keep track of your business and personal mileage for the tax year. Tip. Take a photo of your odometer New Year's Day, which we do this all the time. Really, I do it on December the 31st when I know I'm done driving. Same thing. But you save it so you can always see where your mileage stood at the beginning of the tax year. So that's a good rule of thumb. As with other tax deductions, you'll need to determine the percentage of your mileage that applies to your business. And if you get smart, you'll realize, okay, I need to be figuring out how to make sure that every mile I'm driving is connected to business, not just personal use. And that just comes with being strategic. Now, the best way to do this is with a mileage log. You can keep track of all of your mileage during the year and note what use is for business versus personal. So for 2024, the rate is 67 cents per mile. For example, if you drove 5,000 miles for your business, you would get a 3,350 tax deduction using the standard mileage deduction. Similar to what I said, if it's 70 cents for the year 2025, then it'll be a $7,000 tax deduction if you drove 10,000 business miles. So Uber makes it easy to track your miles. So if you're using that app, then you can tap into it and get the benefits from that. But since this is not just about Uber, I just want to kind of overview these things. If this applies to you, then hopefully you can take a screenshot of this and get an understanding of an Uber driver who drove 10,000 miles in the previous year. And then 5,000 of those miles were for business. The driver actual expenses included these things: $1,000, $1,500, $6,000, $400, $100, $500, and then it broke down to splitting that in half if it was half and half. However, full-time Uber driver might have drove 40,000 miles, and then they were able to have all of these expenses associated with it, and they totaled 11,000 plus, but they did 75% business. So they were able to get an 8,000 plus deduction. Now, using the standard mileage rate, the driver will multiply the number of miles driven for business, which is if it was 30,000 miles, by the standard mileage rate of 67 cents per mile, which comes to $20,000 and $100. So in this example, the Uber driver partner is able to deduct $11,625 more by using the standard mileage method than using the actual expense method. So that's why they say weigh it out and see which one works best for you. But remember, starting out, it's important to strongly consider using the standard mileage method. That way you can alternate between the two. So what are the pros and cons of standard mileage method? Well, there are several benefits of using the standard mileage method, including it often results in a larger deduction for those who do significant driving. It allows more flexibility as you can switch to the actual expense method in future tax years. Record keeping is usually simpler. There are even apps that can do it for you. We have an app that we've been using for years that allows you to, use it. And a lot of times they have these apps that can track expenses. Track your mileage as well with having it connected to your GPS. And it's typically easier to calculate your deduction using the IRS rate per mile. However, the standard mileage method isn't right for everyone. The potential drawback with this method is that you might end up with a lower deduction if you didn't drive a lot throughout the year. So that's the only downside. But if you know you drive a lot throughout the year, especially when it comes to travel, etc., then that should be a win-win scenario for you. So what are the pros and cons of actual expense method? Consider the pros of using the actual expense method when preparing to do your taxes. So this method allows you to account for vehicle depreciation in your deduction above and beyond what would be included in the standard mileage rate. And it varies on a year-by-year basis. For 2024, the depreciation amount was 30 cents. 2023, it was 28 cents. It often results in a larger deduction for those who do a moderate amount of driving. So if you don't drive much, but you spend more on your vehicle, then there you go. If you have more expenses or a more expensive vehicle, you may be able to get a higher deduction. You had a large car-related expense like a major repair, you may be able to get a higher deduction. So just, do the math and see what works best for you. So some of the potential cons that come along with it is the inability to switch to the standard mileage method if you choose to use the method the first year. So keep that in mind. More extensive record keeping. Definitely there's a lot of record keeping with the receipts and things of that nature. So choose which works best for you. So which is better, the standard mileage or the actual expense method? Which method is going to be best varies by taxpayer. Can't tell you which one is going to be best for you. We don't know you, your situation. So it varies. So when deciding which method to use, some factors you'll want to think about include how much do you drive? What's the value of the vehicle? Whether you're willing to be consistent about record keeping to track expenses. You got to know yourself. This is between you and you. And of course, your tax preparer, accountant, or whomever you're utilizing plays a part. But you're with yourself every day. You know how much you drive. You know your ability to keep records. You know if you're going to track receipts and things of that nature. Know yourself. And if you're looking for a simpler method that doesn't require as much record keeping, then mileage would be better for you. But you have to know yourself and then understand, which one works best for you and double down on that strategy. But always keep an eye on both. That way you can know which one you want to use as long as you use the standard mileage deduction. Initially, it allows you to choose in between which one you want to use. Now, it also is important to note that in order to use the standard mileage deduction rate, you must own or lease the vehicle you're applying the deduction. So if you're trying to do the standard mileage, it must be your vehicle, basically. When in doubt, speaking with a tax professional can help you determine which method you should use for calculating the business use of your car. And what forms do you use? Well, the form that you'll use, whether you use the standard mileage or the standard mileage or a standard mileage method, you'll deduct your self-employed car expenses on the Schedule C. So it all gets reported on the Schedule C. Do you need to keep records of your mileage and vehicle expenses? Yes, you want to definitely consider keeping both, so that way you can see which one works best for you. Now, this is all a lot, but I promise you, this can save you a ton when it comes to filing taxes at the end of the year. The name of the game is figuring out how can you legally lower your tax liability. Basically, keeping more of your hard-earned money. If you earn the money, you're not trying to have to overpay in taxes when you can use money that you already spent throughout the year, miles that you've already driven throughout the year, and use that to lower your tax liability, keeping more of your money. For some people, it allows them to get a larger refund. For some, it allows them to break even. For some of them, it allows them to owe less. It just depends on your situation and which one works the best. But hopefully you got a ton of value. Hopefully you took a ton of notes. If you need to replay it, replay it. Share this with somebody else whom you feel may benefit, and stay on the lookout for the other things that I have that help you put more money in your pocket in the form of tax deductions. Mr. Smith signing out. If you like this video, you know what to do, so do what you know. Salute.